Welcome back to the Did You Know channel. If you're new here, no need to watch the video, just play it in the background and listen. You'll get all the important info without needing to stare at the screen. Regular viewers already know how this works, but if it's your first time, feel free to treat this like a podcast. Today I'm diving into a question I've been getting a lot lately. Should I buy stocks now or wait a bit longer? And honestly, it's no surprise. My inbox has been full of similar messages these past few days. The markets are pretty volatile right now. We're going through one of the fastest sell-offs in the last 75 years, and the overall mood is shaky. On top of that, there's the upcoming introduction of reciprocal tariffs on the 24th, which adds even more uncertainty. So, in this episode, I'll break down what's happening in the markets, share some technical analysis, and go through a few interesting data points I came across. I'll also talk about how I personally decide whether to buy now or hold off a bit longer. If we take a look at what's going on in the markets right now, it's clear this isn't just some regular fluctuation. We're in the middle of the fifth fastest market sell-off in the last 75 years. And that's saying something considering everything the markets have been through over the decades. This didn't happen overnight. Volatility is extremely high right now, and so far, there's no real sign of things calming down. One key date that everyone's watching is the 24th of this month. That's when the reciprocal tariffs are supposed to kick in. And until then, I expect the markets to stay pretty tense. That's also what makes it so difficult to make clear-cut decisions in this environment. But at the same time, these kinds of moments often lead to interesting opportunities down the road, if you keep your eyes open and know what to look for. When I look at the technical side of things, I mainly track two major ETFs, QQQ, which follows the NASDAQ, and SPI, which mirrors the S&P 500. And right now, both are giving us some pretty clear signals about where the market stands. Let's start with QQQ. It's currently down around 13.5%, and the price just tested the 200-day moving average from below. That's a pretty significant technical moment because the last time we saw something like this was in 2020. And back then, it was followed by a year-long bear market. Of course, that doesn't mean the same thing is going to happen now. In 2020, it was all about high inflation and rising interest rates, whereas today, the Fed is actually leaning more toward cutting rates. So it's a completely different market environment, but we still can't ignore those technical signals. Now for SPY, the ETF for the S&P 500, the story is similar. It dropped into correction territory, around minus 10%, and closed Friday on a pretty ugly note. The price also hit the 200-day moving average and bounced back downward. The one positive I see for now is that the price hasn't retested the previous low, and that's true for both the NASDAQ and the S&P 500. But that could change fast, especially with Monday's open, which I expect to be extremely volatile. Now, in a perfect scenario, I'd love to see a gap down at the open, a quick test of the previous low, and then a strong reversal with a big green candle that closes above Friday's close. That would be a really bullish signal in my view. But again, we're in a very volatile phase, so it's all about patience and staying alert. As I was going through some of the latest market data, I came across a few things that really stood out, especially if you're someone who's trying to understand the bigger picture and think a bit more long-term. The first thing that caught my eye is the quarterly portfolio rebalancing. Specifically in the US, pension funds are expected to buy around $41 billion worth of American stocks this week. That's actually the fifth largest expected rebalancing in history. And if you look at the chart, similar moves happen during big market moments, like the 2020 COVID crash, the trade war in 2018, and even further back in 2012 and 2009. So historically, these kinds of rebalancing periods have often meant that a wave of capital could flow back into the markets, which is definitely something to watch. The second point is about retail investor sentiment. Right now, retail investors are extremely bearish, meaning they're very skeptical about the market. That sentiment is currently at levels we last saw in 2009, after the housing crisis, and again, in 2022 when the market was bottoming out. And here's the thing. When retail sentiment is this negative, it's often viewed as a contrarian indicator. Basically, when everyone thinks the market is doomed, that's often when it starts turning back up. And then there's the behavior of hedge funds. They have lowered their exposure to the so-called Magnificent Seven, the big tech stocks, to the lowest level in 2 years. At the same time, fundamental long-short hedge funds are holding the smallest amount of long positions in the last 5 years. And again, that's something that can be seen as a contrarian signal, because the last time we saw this kind of setup was near the end of the 2022 bear market, and the market started building a new bullish trend shortly after. One last stat that really stood out: the amount of cash sitting on the sidelines. Right now, money market funds are holding a record-breaking $7 trillion. A year ago, it was around $6 trillion. That means a huge chunk of capital is still sitting in savings accounts, bonds, and other low-risk vehicles. And if even part of that money flows back into stocks, it could give the market a solid push upward. If we take a look at how markets have behaved historically during similar rapid sell-offs, I came across a pretty interesting stat from Bloomberg. According to them, the current sell-off is the 5th fastest in the past 75 years, and it happened in just 20 days. What's really fascinating is what usually happens after moves like this. Statistically speaking, looking back at previous times when the market dropped this fast, the average return 1 month later was plus 6.3%. After 3 months, it was plus 9.1%, after 6 months, plus 14.9%, and after 12 months, markets were up by an average of plus 20.8%. Of course, these are just averages. There's no guarantee history will repeat exactly the same way. But it does give us some interesting perspective on what often follows these kinds of sharp declines. There was only one exception during the COVID crash, when the market continued dropping even after a month. But other than that, the long-term numbers paint a pretty optimistic picture. For me, this is just one more signal that even if the market feels chaotic and uncertain right now, history shows that sharp sell-offs are often followed by periods of growth. It doesn't mean that'll happen tomorrow, but when we zoom out and look months or a year ahead, it's definitely something to keep in mind. One thing that really caught my attention, and might surprise you too, is that most of the gains in the stock market actually happen overnight. Yeah, it sounds strange at first, but it's true. The biggest moves often happen after the market closes, outside of regular trading hours. If you look at a chart of the S&P 500, you can clearly see that intraday returns are often minimal or even negative, while overnight returns tend to be stronger. And what's even more interesting is that these overnight jumps usually happen during market corrections or periods of high uncertainty. That's when those quick, sharp rebounds tend to show up, and they often happen while we sleep. This is also one of the reasons why I try to stay invested, even when things seem shaky. Because if you miss just the 10 best days in a given year, you miss out on the majority of the market's gains. And those best days usually come right after the worst ones, during panic and sell-offs. So even though the market's super volatile right now and full of uncertainty, I try not to let it shake me. Because chaotic times often hold the biggest opportunities. Now that we've gone over the state of the market, the technical analysis, and some historical data, I want to share 2 specific companies that I personally hold in my portfolio. And they're not there by accident. Both of them, based on my own criteria, are undervalued and sitting at interesting technical levels. The first one is Meta, a company that really doesn't need much introduction. On the daily chart, it's still in a solid uptrend and holding above the 200-day moving average, which is a pretty strong technical sign. There was a sharp sell-off on Friday, and the price tested the previous low, but it's still holding for now. What happens on Monday and Tuesday will be key. If the price can move back above $587, I'd see that as a very positive signal. My fair value estimate for Meta is somewhere around $700. So, at current levels, that makes it about 20% undervalued. And that's exactly why I recently added more to my position. It just makes sense at these prices. The second company in my portfolio is Google. Now, technically, it doesn't look as strong as Meta at the moment. It's dropped below the 200-day moving average, which isn't great from a short-term perspective. But the price is now sitting on a pretty strong support level. That level has been tested before, first as resistance, then twice as support. And I'm watching to see if we get another bounce here. Of course, support isn't some magic wall. The price can absolutely break through and keep falling. But if we do get a solid reversal from this level, it would be a strong sign that Google still has some fight left. Right now, it's what we would call a falling knife, very volatile. But that kind of volatility is exactly what I try to take advantage of when it comes to great businesses. Now, just to be clear, I'm usually not a huge fan of mega cap stocks. I normally focus on smaller companies with more room to grow. But when big names like Meta or Google take this kind of hit, drop below fair value, and sit at major support levels, that's when they start making sense to me again. This question, whether to buy now or wait a bit longer, is honestly one of the hardest, especially when you're looking at the short term. And to be real with you, nobody has a clear answer. You can analyze charts, follow the data, watch market sentiment, but none of us has a crystal ball. What's worked best for me over time is not getting too caught up in whether this is the bottom or if I should hold out for a better price. Instead, I focus on having a system, not some perfect setup that only works in ideal conditions, but something I can stick to no matter what the market is doing. Since 2008, I've learned one thing. Whenever I've actually bought right at the bottom, it was pure luck. Most of the time, it just doesn't work like that. In the short term, the market is emotional and often irrational. It doesn't care about a company's fair value. It reacts to headlines, panic, fear, all that. That's why I think it's way more important to ask yourself one question before entering any position. Am I investing for the long term, or am I just trading short term, maybe for a few weeks or months? That answer changes everything. For me, if I'm investing long term, like 2, 5, even 10 years, I don't stress about catching the lowest price. I look for businesses that are trading below their fair value and are either in a trend or sitting at strong support levels. And when I find that setup, I enter the position. But if I'm doing a shorter swing trade, something I might close in days or weeks, then technical analysis plays a much bigger role. I pay close attention to price action, key levels, volume. All of that matters more in the short term than fundamentals. So my whole approach isn't about trying to time things perfectly. It's about having a clear framework that allows me to make decisions calmly and confidently, even when the market is going crazy. What really helps me stay on track, even when the market feels unpredictable, is having a system. Not one that depends on what mood the market's in, but one I can stick to consistently, no matter what's going on. At the core of it all is regular income. I think that's absolutely key. Warren Buffett, for example, solved this with insurance companies. They collect money upfront from clients and only pay it out later when a claim happens. So in the meantime, they have a huge amount of cash to invest. That's basically the engine behind Berkshire Hathaway's massive positions in the stock market. For regular people like us, that steady income usually comes from a job, a business, or maybe rental properties. And if you can do just one thing, spend less than you earn, you've got the foundation for building real wealth. That's the simplest and most powerful path to financial freedom. And that's why I personally don't stress too much about the question, should I buy now or wait? If I know I'm going to get new cash every month or every quarter, then I also know I'll have another chance to invest. Maybe in a month, maybe in 3. And that takes the pressure off trying to time the perfect entry point. From a long-term investor's perspective, I see volatility as opportunity, not risk. If I've got cash ready and I see a strong business that's trading below fair value and sitting near a solid support level, I'll jump in. And if the market freaks out and the price drops even further, I'll just buy more, because I know it's not the end of the world. It's just another chance. When I look at what's likely coming over the next few days and weeks, one thing's pretty clear. volatility isn't going anywhere just yet. At least not until the 24th of the month, when those reciprocal tariffs are supposed to kick in. Until then, I expect the market to stay tense and unpredictable. That's why I think it's super important right now not to focus only on the major indexes, but to really zoom in on individual stocks. Personally, I'm watching companies that are holding up better than the broader market, the ones that haven't completely broken down technically and are still respecting their trend. To me, that's a strong sign. It shows that even during all this chaos, investors still have faith in those businesses. And those are exactly the stocks I'm looking to slowly build positions in. Not all at once, of course. I'm scaling in carefully, based on how the market moves. I also have my eye on a few smaller cap companies, ones that are currently pretty beaten down. But that's kind of the point. These are the ones I believe have the potential to multiply over the next few years. It's a long game for sure, but the foundation for those future gains is often laid during times like this. So, to sum it all up, if you're a long-term investor, it really doesn't matter that much whether the market is going up, down, or just moving sideways. What matters is having a plan and sticking to it. That's what this is all about. In the short term, markets are emotional, unpredictable, and often completely irrational. But over the long run, they always come back to fundamentals and reality. That's why I don't obsess over trying to perfectly time the bottom. I'd rather focus on finding solid businesses that are undervalued, stick to my system, and keep investing regularly when I have new capital. And when there's a sell-off, I see it as an opportunity, not a problem. So, if you're investing too, don't let the short-term noise throw you off. Focus on what you can control, your budget, your plan, your mindset, and leave the rest to the market. Because in the end, it's going to do what it wants to do anyway. If you found this video helpful, feel free to give it a like or share it. It helps get this kind of content in front of more people who care about investing. And if you're new here and haven't subscribed yet, you're more than welcome to join. I post similar content regularly. As always, thanks for listening, and I'll catch you in the next one.